Hello, everyone. Thank you, everyone, for joining us today. So we're about to start. If you want to leave in the chat where you're from and from where you're watching us, so we're happy to have you here today. And also feel free to write down in the chat box and the Q&A box all the questions that you may have during the presentation. I'm also sharing in the chat box all CVs so you can have a look at it. We are Real Estate IQ for the ones that haven't heard of us before, and we are so happy to have you here today. So let's get started. We have more than 12,000 registered attendees, more than 500 webinars hosted, and more than 100 keynote speakers. And let me tell you a little bit more about us. Oh, sorry. A little bit about who we are. So we are a lead generation software and solutions company focused on helping real estate investors like you kickstart their business. So we strive to become the platform and resource to help them achieve their real estate dream. So what do? We provide real estate solutions to make deals come true. We offer a suite of lead generation automation tools, educational content, and additional services to the real estate industry to help entrepreneurs kickstart and grow their business. So this is the streamline of our solutions. We offer off-market leads to find the freshest data mined straight from the card houses daily on our data portal. We also offer events, re-education led by experts, and training on our solutions. Skip tracing, get homeowners' contact information effortlessly. CRM, perfect to track listings and marketing campaigns. Virtual assistants, virtual support for administrative tasks, customer service, and more. Fire, personalized financial checkups and consultancy. EVA, run real estate comps in seconds with our renewed evaluation CMA. CLM, we now provide custom off-market data mining all over 50 states. Last but not least, our membership, tailor plans to meet every investor's needs. So today we bring you this deal of the day. This golden lead to grow your business. You can contact us to learn more. So you can sign up to get the full address and submit your deals to advertise. Feel free to scan the QR code that appears on the screen so you can join us and get all the information of this pre-foreclosure. So you won't miss this amazing deal. You can also join us in our newsletter so you can stay informed with Real Estate IQ's weekly newsletter, get market insights, data updates, and event highlights. All you need for successful real estate investments. So by scanning the QR code that appears on the screen, you will get access to our newsletter so you will stay informed and appear in our news. So you will stay tuned of our weekly webinars and in-person events. And also you can request a consultation, a complimentary 30-minute in-depth one-on-one demo of Real Estate IQ solutions with one of our experts. So we will walk you through everything you need to know. For more information, you can contact Bracenet at realestateIQ.co or also scan the QR code that appears on the screen and answer the poll that should appear on your screen as well. These are our social media accounts where you can follow us as well. We are in Instagram, Facebook, YouTube, and LinkedIn. And by using the QR codes that appear on the screen, you will have access to our social media accounts where you will have all the information about us as well. This is the Academy Learning Made Easy. Here you can find our best webinars and short courses so you can stream it at any time and from wherever you're based. So log into stream so you won't miss any of our webinars and all the information of them. Today we have Paul Lamnatos talking about insider tips for effectively mastering the BRRRR strategy. So we are so happy to have him with us today, sharing his expertise with us. I'm gonna stop sharing my screen, and before moving forward with him, we're gonna have Catherine from our sales team talking about our tools. Catherine, thank you everybody for joining us today.
Thank you so much. Good afternoon, everyone. Again, I am Catherine, one of the account managers here in Real Estate IQ. I am here now to introduce to you our portal. Hope you can all see my screen.
Perfect.
Okay, perfect. So since you can now see my screen, you'll be able to see that we have here right now our portal. That would be at therealestateIQ.com. You just need to sign up using your REIQ credentials. If you do not have one yet, you can create one by using this button, sign up. As for me, I already have my credentials ready. So I'll just need to log in. Upon logging in, this is where you'll be sent to. Here you'll be able to see some of the services that we offer here in Real Estate IQ. But the most important part of this portal is the off-market leads. You'll see the tabs on the left-hand corner. We have our off-market leads tab. This is where you will be getting your listings on a daily basis. That's Mondays to Fridays. Have here different off-market lead types. We have pre-foreclosure, tax sales, and so on. The number of off-market lead types that you'll be getting will vary depending on the availability of the leads on specific markets. For now, I will be focusing on our pre-foreclosure. So we have here our filters, which will help you filter your search by the property type, property characteristics, valuation, and equity. And for most, this is one of the most important, which is a date filed. So we have here the option for date added. This is when we uploaded the data on our portal. So for those who try, there are a lot of customers who actually extract our lists on a daily basis. So you can use this date added filter to do that. We also have the auction date if you wanted to extract leads on, I mean, for a specific auction, you can use this one. And we have the record date, which is when it was recorded from the county's courthouse. Also, some uses the occupancy filter to identify if the property is occupied by the owner or not. So here we have some of the important that you need regarding the listings. But if you wanted to know more and see more details, you can just simply click on the details button on the right-hand corner. So we have here the property information and the loan information itself. And for those who have the premium subscription, because we have the standard version and the premium version of our leads, the premium includes the contact information. So it's already skip traced. We have our email addresses, the cell phone numbers, landline, the relatives information included as well. That way it would be easier for you to get a hold of the property owner. You can also export the file if you have like a CRM that you are using by using these buttons right here. You can also save your filters. And as you have mentioned CRM earlier, by the way, we do not just offer off-market leads, but we also have our CRM that you can subscribe with, so you can enjoy managing your leads using it. Aside from this, we have the Contact Us tab, where if you have any problems, questions, or anything regarding the service that we offer or any assistance that you may need, you can always send us a ticket or directly contact your account manager for that. We have our FAQ tab for those who want to get to know more about the specifics of these portal. And we have our Academy tab for those who are interested to learn more about the trainings and webinars that we have conducted before, most of which are going to be helpful in terms of your real estate business. If you guys have questions or interested with the service that we are offering, or if you wanted to get to know more about this, you can always answer the poll. And I believe there will be one that you'll be asked with if you're interested for a one-on-one consultation or a demonstration of the services that we offer. Thank you so much, everyone. You have a great one.
Thank you very much. And thank you everyone for watching. Moving forward to you, Paul. Feel free, everybody, to share your questions in the Q&A box and in the chat box so Paul is able to answer them. Thank you.
Hello, hello. So I am going to plug this in so that way no one wants a laptop to die during the middle of a presentation. That would not be fun. All right, so welcome, and let's get going. So the name of this presentation is Mastering Insider Tips for Mastering the BRRRR Strategy in Real Estate Investing. My clicker seems to give me problems the last few times I've used it, and right now doesn't seem to be any different. All right. All right, by a show of hands, who believes this slide to be true? Okay, who doesn't believe this slide to be true? Okay, so the idea of knowledge is power isn't totally the case. See, I know there's Valentine's Day on March 14th, but the idea of me knowing there's Valentine's Day on March 14th and then me not taking the action behind the knowledge, well, that just doesn't serve me very well. My wife's likely not going to be too happy about that. If anybody's ever seen the cartoon G.I. Joe, it always ended the same way. And the way it ended is at the end of it, it says knowledge is half the power. And I never fully understood what that meant until later in life. I got, well, just because I know it's Valentine's Day, if I don't take my wife to dinner on Valentine's Day, if I don't buy her chocolates, buy her flowers, well, then it really doesn't matter the knowledge behind it. So knowledge is not power. Knowledge plus action is power. And this is my invitation to you today to apply the knowledge that you learn. And so in moving on, there's a slide. So we're going to go over the BRRRR method today. The BRRRR method, if you've never heard of it, it stands for buy, rehab, rent, refinance, repeat the process. So what you're looking to do is acquire properties, renovate them, refinance them, and then just, well, let's do the process over and over again. So the first part, of course, is buy. Now, when you're buying a property, you want to buy an ugly property, right? When you're utilizing the BRRRR strategy and you're buying a property that is pretty, well, it doesn't work. So the perfect way for the BRRRR strategy to work is when you're buying a property that needs renovations, we're going to renovate that property. And then based on the renovations that we make to it, we're going to increase the value of that property and utilize the equity that we've created as our down payment. So rather than go buy properties with putting down 20, 25, 30% that are turnkey ready, meaning you turn the key and they're ready to be leased out. Instead, we're going to buy properties that are distressed, that need to be renovated. We're going to bring them up to today's market value of properties and others in the area that are comparable to it, increase the value, and then use that increased equity, the increased value, as our equity for our down payment. Now, the uglier the house, the better, because it creates more opportunity. Now, where do we want to find deals? Look, Real Estate IQ does a fantastic job of lead generation. You different subscriptions that they have. You can find deals, whether it's public records, whether it's directly in seller finance. It's tons and tons of different leads that you can find directly from Real Estate IQ site. Outside of Real Estate IQ site, you can find deals online, whether it's HAR, whether it's Zillow, whether it's Realtor.com, whether it's social media, whether it's the different investor lift websites and different wholesale platforms that sell online properties. You can find properties online, and often I see investors just miss the whole opportunity of being able to get a property just off the MLS. I myself have properties off the MLS because, well, I'm able to see a deal where a seller wants to sell a property. I negotiate good terms, and I'm able to buy the property prior, well, with it being listed online. So this whole idea that you can't buy properties that are listed online is just not true. So different places to find them. And then where else can you find deals? Look, real estate investors themselves sell deals. Wholesalers sell deals. Realtors sell deals. You can drive for dollars and create your own list. You can work with probate attorneys. You can work with divorce attorneys. Different, there's neighbors, there's colleagues, there's friends, there's so on and so forth. And so many times what happens is real estate investors, you're not talking enough to the people that you're talking to about what you're doing. Let me say that again. You're not talking to the people you're talking to about what it is that you do for a living. And if buying properties is something that you do, well, we always want to look. We want to look online, and then we want to look offline. And great places to look offline, again, are with wholesalers, are with realtors, are with driving for dollar signs, putting your own mail list together, different attorneys, and so forth. Now, I often get asked this question, Paul, how do I calculate my cash to closing when I come across a deal? And how do I know whether or not this deal fits a BRRRR strategy model? Because again, I've mentioned if you buy a property that needs no renovations and is being sold for top of market, well, that property wouldn't be qualified for the BRRRR strategy. We need to find properties that need to be renovated, and based on the renovations that we're going to make to the property, we're going to increase the property value, and therefore that equity that we're capturing based on the renovations we're making, that's going to serve in lieu of our down payment and allow us to refinance into a long-term loan. But anytime you're starting off with the property, what I always tell clients is to pull out a pen and paper and to draw a line down the middle of the page and then a line across the top of the page. On the left side of that line, you're going to write money I need. And on the right side of that line, you're going to write money I get. Now, under the column where it says money I need, there's three types of funds that you need. You need money to acquire the property, you need purchase price, you need money to renovate the property, and you need closing cost funds. Whether you buy the property cash or not, you're going to have closing costs. And then the fourth line under money I need is total. So let's put that in. Again, it's purchase price, rehab, closing costs, total. Now we go to the right side of the page and 4 columns again. These 4 columns, top of the line, we're going to write 70% of ARV. Next line is ARV equals, leave a blank space, times 70%. The fourth is total. So now what we have is we have two columns, and we've got fill in the blank. So we want to fill in the blank each time we're doing a deal. And in this example, we've got a purchase price is $245. Our rehab cost is $75,000. Our closing costs are $12,000. And the total money we need to bring to closing is $332,000. Now we go to the right side of the page where it says money I get, 70% of ARV. ARV is $450,000. 70% of that is $315,000. So we've got $322,000 is the money that we need. The money I get is $315,000. So the difference in the two is $17,000, which that is your cash to closing. Now, I want to run that example again, because often what happens is, well, we get it, but when we see it again and again, it makes more sense, right? So again, we've got a different deal. We want to pull out our pen and paper. We want to draw a line down the middle of the page, draw a line across, left side of that line, money I need, right side of that line, money I get. And then under money I need, we're going to do purchase price, rehab budget, closing costs, total is the fourth line. We go to the right side of that page, top line, 70% of the ARV, because in private hard money financing, you can go up to 70% of the after repair value. Next line, we're going to write ARV equals, leave that blank to fill in the blank of what the ARV is. Third line, times 70%, and fourth line, total. So now that we have it here, let's fill in the blank with what the numbers are. Now, the numbers in this example to buy it is $165,000. You need 20 in renovations. Closing cost here is going to be $11,000. To add all that up, we get $196,000. Now we go to the right side of the page where we get money I get, 70% of $270,000. The ARV is $270 in this example. 70% of $270 is $189,000. So the difference between $196 and $189 is $7,000. That's what you bring to closing in this example. These are good BRRRR strategy deals right here. Moving on. So how to calculate your private or hard money loan payment is another question I always get asked. So look, if you're looking at calculating your private or hard money loan payment, it's very easy. You take your loan amount, you multiply it by your interest rate, and you divide it by 12 months and match your payment. So for example, if you take $320,000 at a 10.99% interest rate, 320 times 10.99%, divide by 12, get $2,931. That's your monthly mortgage payment. Another way of calculating your private or hard money loan payment is take your interest rate, divide it by the number of months in the year. So let's pretend your interest rate's 11.99. Divide 11.99 by 12. You're going to get 1. Now that 1%, that's your monthly payment based on your outstanding loan balance. So if your loan balance is, let's say, 250 grand, 1% of that be $2,500. That's a quick and easy way. Now, if you want to get it super, super accurate, what you're going to do is you're going to take your loan amount, you're going to times it by the interest rate, you're going to divide it by 365, that's the number of days in the year, then you're going to round that number to the second decimal, and you're going to multiply that number by the number of days in that month. Because as an investor, you want to pay interest based on the money that you've borrowed, right? And the number of days that you borrow that money. So some months have 31 days in it, some months have 30. There's that other month that's got 28. So based on the number of days in the month, that should dictate your payment. And so the way you truly calculate is you take your loan amount times your interest rate, divide by 365 days, round that number to the second decimal, and then multiply that number by the number of days in the month. In this example, $2,987. All right, look, as a real estate investor, you want to avoid paying these fees because all of us private hard money totally get it, that you know to ask us, what's our interest rate? How many points do we charge? How fast can we close? And how much money do you have to bring to closing? Like, those are questions that every investor asks every private or hard money lender. But it's so much more to that you want to ask to make sure that you're not getting nickeled and dimed with paying a whole bunch of junk fees. Like, for example, what's your appraisal fee? Like, how much am I paying for an appraisal? Typically, appraisals are anywhere from $500 to $750. That it starts to add up, as you'll see with the other questions we have here. What loan term is for the rates and points that you're quoting me? See, private hard money lenders have a habit of quoting you on 6-month loan terms and then just charging you extension fees if your loan goes on past that. Well, if you need 12 months, why would you get a 6-month loan term and compare that to other lenders when you need a 12-month loan term? Ask them, what happens if I need to extend my loan? Do you charge me extension fees? And if so, what are they? The other side of that, flip side, is what if I pay my loan off early? Like, instead of paying off your loan later and your loan taking longer than 6 or 12 months, what happens if you only have the loan for 3 months? Do you have to pay a prepayment penalty? Do you charge monthly servicing fees? Believe it or not, a monthly servicing fee is a fee to have to pay a third party to collect your mortgage payment to pay your lender. I know, let me say that again. A loan servicing fee is a fee that you pay to a third party to process your payment, to collect your payment, and then send it over to the lender. So you're not paying the lender, you're paying a third-party servicing company that then pays the lender. Well, look, if you're working with a lender that can't figure out how to accept the payment from you, I think the very least they can do is not pass on the third-party cost to you. So if you have a $2,000 a month payment, a lot of clients, investors have to pay $2,040 or $2,060 because that other $40, $60 that gets paid every month, again, is a monthly servicing fee that you're having to pay to a third party to collect and process your payment. That's a junk fee. And if you're paying $40, $50, $60 and you've got a loan for 4, 6, 8, 10 months, look, all these little fees add up, and they start eating away at your profits. And as a real estate investor, you make money when you buy, and guarding yourself from so many of the junk fees along the way is a way of making money when you buy. See, when you have financing that's tied to your acquisition cost. So I'm buying a property for X amount, but now I've got financing tied to it. Well, that financing can make that deal good or it can make it bad. Because if you've got a good deal with bad financing, it's just a matter of time for that deal to turn bad. But if you've got good financing with a good deal, that's just an awesome home run there. So you want to make sure you're not getting nickeled and dimed with things like servicing fees, extension fees, appraisal fees, prepayment penalties. And that's before we even talk about draw fees, inspection fees. See, you may or may not know that as a real estate investor, you do not receive your funds in advance. You get your money in disbursements and reimbursements. Sorry, let me say that again. As a real estate investor, you don't get your money in advance, you get them in reimbursements. So if you have a property that you're renovating and we're going to spend $75,000 on this renovation, well, that money's held aside in an escrow account for you to be dispersed as you complete the renovations in reimbursements. So you say, hey, I'm going to paint the house and I'm going to do the flooring, for example. Well, once you do that, you'd make a draw request. The lender comes out and inspects the work that you did and then releases those funds to you. Well, there's a fee for that. And that fee is anywhere from the very, very cheap side, $95, to as much as $300. So if you're doing 4, 5, 6 draws at $200 each, we're at $1,000 very, very quickly here. Then how fast do you fund the draw request? A lot of times, real estate investors, I needed my money yesterday because I've got my contractor to pay. I need the job to keep moving. I've got to keep going along. And what happens is, well, you ask the funds for your lender, and then you're not getting those draw funds for a week or for 2 weeks. And now your contractor stops working on the job, which is absolutely the worst thing that can happen. So you want to know how fast do you fund your draws? And then is there a payoff fee? I skipped over that. A loan payoff fee. So what you may or may not know is when you go to pay off your loan, like I want to pay off my loan and I want to be done with it, you have to get what's called a payoff from your lender. And that payoff is a statement that tells you and the title company how much you owe on the loan. So before they give you any money, they being the title company, the payoff funds have to go to the lender because the lender's owed money. Well, lenders will charge you a fee to generate a statement that tells you how much you owe them. I think that's asinine because the lenders should know how much you owe them. They're collecting money from you. So why on God's green earth would a lender charge you money to generate a document that tells you how much you owe them? Typically, that's anywhere from $75 to $200. Again, add it on top of the appraisal cost, add it on top of a prepayment penalty, or add it on top of an extension if you have one. Add loan servicing fees on top of that. Add draw fees, add inspection fees, add a loan payoff. I mean, this starts to add up and can eat into thousands of dollars into your profits. And if you don't care about a few $1,000s, well, that's just silly because with a few $1,000s, you can market in your business and you can get more leads. So if you're saving money on lender junk fees, you put that money into your marketing generates more leads. When you have more leads, you get to do more deals. It makes sense. So if nothing else, call it your marketing fund. This money that I'm going to save by not paying nickel and dime junk fees to these private and hard money lenders, I'm instead going to shop smartly. I'm going to ask the right questions, not get nickel and dime. And then the money that I save, I'm going to use that to put into my business, to market, to generate more leads so I can get more deals. Just makes complete sense. Here's the biggest one of all. And if you forget all that I talked to you about, if you remember this one, you're going to save more money than with all the others combined. I make a solid argument for it. And what that is do I pay interest on my undrawn rehab budget? Look, I hate to insult you, but if you're a real estate investor, you're paying interest on your undrawn rehab budget, AKA money you have not received. Like, think about that for a moment. You're going to pay interest on money that you haven't gotten. So a lender is going to hold money aside for you in an escrow account, which, by the way, they have to do that to fund your loan. So the next time someone says, well, I have to do it, and because I have to do it and I can't earn interest on it, I can't make money on it, I have to charge you money, that's just a BS answer. And if you take it, well, you just fell for some BS. Because although that might be the case and they might have to charge you, you don't have to borrow from them. You can go borrow from another lender that's not going to nickel and dime you with charging you interest on money you haven't received. See, I ask you, if you had a credit card right now in your wallet and that credit card says you have access to $10,000 and you don't use that $10,000, but next month, but you don't use that $10,000. And next month, what you do is you end up utilizing those funds. Excuse me just a moment. Yes, sir. Yep. We're not having lunch today, but Oscar will grab you. Sorry, we just had a guest walk on in. We don't have a lunch today, but Oscar will be more than happy to help you. Mind helping this young man? No worries, no worries. Sorry about that. The next time a lender tells you that they have to charge you interest on your undrawn rehab budget, it's just not the case. And I want you to imagine you having a credit card in your wallet and you pay interest on that credit card, even though you've never borrowed that money. I mean, that just seems absolutely asinine. I wouldn't do it. I'd be furious. So if you're looking to save money, that by far is the one to save the most money on. Now, when you're rehabbing a house, God you trust and everyone else you verify, we get 3 bids and we verify. So I often talk about how you can get a contractor. Well, how you can get a contractor is you just drive around. There's literally some outside right here. You can see them working. You can look online, but you get 3 bids on every job that you have. And I like contractors that are fully licensed, bonded, and insured. It just makes the process so much easier. The draws, again, they're in reimbursements. So whenever you have a rehab budget with a lender, you're not getting that money up front. You're getting that money in reimbursement. So very key to know. I'm a big fan of getting permits and doing things the right way. I've done things without getting permits. It's come back, it's bit me. I'm a fan of getting permits. All right. A big tip that I have for real estate investors is make sure that you're accounting in lead times with supplies. I've had investor clients, I've had friends who they're building houses. There's a specific window they want. The windows take too long. The house, well, they're having to do other ways of weathering it in because they're having to wait on their materials to come in because they didn't factor in the lead times with their appliances. If you're doing a custom house, you're doing an upgrade. You're doing higher end finishes and you need a better fridge, you need a better stove. Well, a lot of times you want to order that stuff in advance, and I've seen investors not take their lead times into account, which ends up hurting them.
Thank you.
Oh, no worries at all. You're taking off for lunch?
I'm too early. 24 hours.
Oh, got it. Hey, that's cool. We'll be here tomorrow.
Yes, sir.
Oh, you're a big dog.
Yes, sir.
Oh, awesome. See you tomorrow.
All right. Yeah.
So huge. You always want to include your rehab budget in your loan amount. And the reason you want to include your rehab budget in your loan amount is when it comes time to do the refinance, if you're trying to cash out of your loan, what happens is there's waiting periods, what are commonly referred to as seasoning requirements. And you want to cash out on your loan, but you have to wait 6 or 12 months. And a way to not do that is to include your rehab budget in your loan amount. So I want to run through another example here of a deal we're looking at. And the numbers on this one, same as 165 to buy it, 20 to rehab it, 11,000 in closing costs. We need $196,000. Right side of the page are ARVs 270. 70% of 270 is 189. So we can borrow 189 here. So the money we have to bring to closing is $7,000, right? Now, every now and then I have a client go, Paul, I don't want to borrow this $20,000 rehab budget from you. Instead, what I'd rather do is I'll pay it myself out of pocket. And the reason they do that, and I understand why they do that, is because they don't want to pay interest on the money. They don't want to pay points on the money. They don't want to have to go through the draw process. And they don't want to just really have to, it's only $20,000. Like I'll just pay for it out of pocket with the idea that they'll get that money back when they refinance because they're going to do a cash out refinance. Well, that's a mistake because a $20,000 rehab is probably going to take 1, maybe 2 months. And then they can immediately refinance their loan once the house is finished. Now, if that investor wants to do a cash out, they have to own that property for either 6 months or 12 months, depending on the loan type they choose. So now they have to either pay more interest to the private or hard money lender, or they have to forego doing the cash. They have to forego getting the cash because they don't want to wait that long. But if they include it in their loan amount, now you don't have a waiting period to cash out, and you just refinance it within your loan. Excuse me. And the really cool thing is if when you work with a company like ours, you don't have to pay interest on that undrawn rehab budget. So that $20,000, you don't have to pay interest on it. So you can wait to get to the very end, finish the property, start your refinance, pay off the higher loan balance, the 189, and then get the $20,000 as a final draw. Because when your loan amount's 180, like 189, like we see in this example here, you're only paying interest on $169,000. Now, why? Because you haven't borrowed your $20,000. You haven't received it yet. You receive your draw funds in reimbursements after you complete the renovations. Well, you can no one says you can't complete the renovations with your own funds, not draw the money, therefore don't pay interest on it. And then when you go to refinance the loan, what happens is us, the lender, turns in a payoff that says your loan's for $189,000. Now we received the $189,000 when your loan pays off and you refinance it, but you only owe us $169. So we keep the $169, and the other $20,000 we'll release it. Well, we release it back to you in the form of a final draw. So you get that money back. Again, it's in the form of a final draw. And now you're able to save on not paying interest, draw fees, waiting time on the rehab funds, and you don't have to wait the 6 or 12 months to refinance based on the value of the property, which is what are called your seasoning periods. The other thing that rarely gets talked about is when you're refinancing and getting cash out, that interest rate's always a little higher than when you're refinancing and not getting cash out. So when we do what's called a rate and term refinance, your terms are always slightly better than by doing a cash out refinance. So just things to consider. All right, next is rent. Look, when you rent a property, when are you going to rent it? And then how are you going to screen your tenant? Are you going to rent your property after it's completely renovated? Or are you going to put a for rent sign in the yard during the renovation? I'm not a tax guy, but there are strategies out there to where you list the property for rent as soon as possible. And then your deductions, well, those are tax deductible this year as opposed to being depreciated over, 27 and a half years. So again, I'm not a tax person, but you want to consult your CPA and find out when is the best time to start advertising my properties for rent to take advantage of any tax loopholes that I might be able to. Now, are you going to screen your tenant, or are you going to hire a property management company? Are you going to rent out your property on a short-term lease to, let's say, Airbnb, VRBO, or are you going to do it on a long-term lease with a traditional lease agreement? Those are all things to consider, including doing it yourself or a property management company. And we've heard of short-term living. We've heard of short-term rentals. We've heard of Airbnbs. We've heard of VRBO. We've heard of long-term leases. They've been around forever. What some of our clients are doing is getting pretty creative right now, and they're leasing to assisted living facilities, sober living facilities, halfway houses. So they're looking at different strategies that they can rent out their properties, because as interest rates are going up and it's eating into cash flows, what's having to happen is real estate investors are having to get more creative, stay ahead of the curve, and therefore look to increase their rents and the monies they're receiving. So one client of ours is doing sober living, another is doing some assisted living. These strategies, they're bringing in far more money than a short-term rent or a long-term rent would do. All right, when it comes time to refinance your properties, you've bought the property, it needs to be renovated, you renovated it, you've got a tenant in place, and now it's like, all right, I want to refinance, and I want to get out of this private hard money loan, I want to get into a lower interest rate loan, increase my cash flow, and just move on so I can do this again. Well, you've got 3 loan types. You can do what's called the conventional loan, and that's a loan, the short version there is that's a loan based on your personal income. So if you want a conventional loan, you're going to show your personal income documentation, things like tax returns, pay stubs, W-2s. If you want a non-conventional loan, commonly referred to as a DSCR loan, that's debt service coverage ratio, That's a loan that's based on the income of the property. So instead of being based on your personal income, debt service coverage ratio loans are based on the property income. There is a difference in terms there. Anytime a loan has a higher risk associated with it, the terms are going to be slightly higher. So whenever you can prove that you can qualify for a loan based on your personal income, then that loan is going to be lower risk, therefore it's going to have lower terms. If you're qualifying for a loan and saying, look, I'm not going to qualify for this based on my income, but rather the property income, you can still get a loan. It's just higher risk, meaning you're going to have slightly higher terms. On average, it's about 1% higher in rate and about 1% higher in cost. That number changes, so it's just a good rule of thumb, but it's not the end of it. Big thing to pay attention to on debt service coverage ratio loans and non-conventional loans is a prepayment penalty. The lower the interest rate, you're going to have a higher prepayment penalty. So often I have an investor go, well, Paul, I don't care. I'm going to keep this property for 10 years. I'll take the 5. And I say, look, not so fast. What happens if rates drop in the next 2 years? You're not going to be able to refinance it. And the reason you're not going to be able to refinance, have a prepayment penalty tied to it. Now, can you refinance? Of course you can. You just have to pay the prepayment penalty. So don't just rush into these debt service coverage ratio loans so quickly with the low rate option. Instead, you want to look at all the numbers, not just rate and cost, but what's my prepayment penalty? Because if you are someone who thinks rates are for sure going to drop in the next few years, then it makes no sense for you to agree to a loan term that is a 5-year prepayment penalty. Now, how do these prepayment penalties work? They work on what's called a step down. So you'll have a 5-year prepayment penalty. That means if you pay off the loan the first year, you're going to pay 5% penalty. So if your loan balance is, let's say, $300,000, you're going to pay a $15,000 penalty. 5% of $300,000 is $15,000. You're going to pay a $15,000 penalty for paying off the loan early. Now in year 2, the prepayment penalty steps down to 4%. So if you pay off the loan in year 2, 4% of $300,000 is $12,000. Year 3, it's a 3% prepayment penalty. Year 2, you guessed it. Year 4, you guessed it, a 2% prepayment penalty. Year 5, it's a 1% prepayment penalty. And then after 5 years, you can do whatever you like. So when you're looking at the difference between a traditional conventional loan and a non-traditional debt service coverage ratio loan, one is based on personal income. I'm showing my pay stubs. I'm showing my tax returns. I'm showing my W-2s. The other is based on the property income. And then the third option is a commercial loan. Commercial loans are based on property income as well. And that loan term is, well, it's right in the middle. It's typically a 15, 20-year loan term, and it's designed for multi-unit properties, but single-family houses get commercial loans all the time. All right, credit scores. Look, I get asked this question often. Paul, I'm thinking about getting started in real estate investing. What's first? The first thing you should do is get your credit score above a 780 or start to do so. Why? Well, because when you're getting financing tied to an investment that's based on your credit score could determine your financing for the next 30 years. So if you're someone that has, let's say, a 680 credit score, 712, a 730, and you don't have a property right now, well, you have an awesome opportunity to increase your credit score as much as you possibly can. And once you get it above a 780, then with all lenders, you're getting top tier pricing. I want to be clear, you're not getting the same interest rate with all lenders, but all of us lenders work on a tier base, and 780 to 850 is tier 1 credit scores that get you tier 1 rates. When you have a 760 to a 779, it's tier 2. And then it goes down in 20-point increments. So 79, 720, 739. So if you're going to get financing for multiple years that's based on a credit score, why not increase your credit score as much as you can to get the best rates possible? Once your credit score, you're not going to get financing. It's just your financing is ugly. So when you're below a 680, like, one, forget even negotiating terms. You should just be happy that you're getting financing. But really, you just got to increase your score. If you have a 680, could you get financing? Yes, you can. It's just ugly. You want to increase your credit score as high as you can, ideally above a 780, to get the best of the best financing that's out there. All right, loans that are based on personal income, again, mention what we're asking for. Loans based on property income, we're looking at lease agreement and comparables in the area for other rents. And then the debt service coverage ratio loan formula. I often get asked, well, Paul, how do you calculate the debt service coverage ratio formula? Look, it's very easy. It's how much am I making in rent, divided over how much is it costing me, and what's that percentage. So let's take a look at this. Let's take a look at an example to where we're renting for $2,500. That's the rents that we're receiving, or $2,500. The cost is $1,839 per month. So we're taking $2,500, we're going to divide it into $1,839, and that's going to give us, should give us 1.36. Yep. And so again, debt service coverage ratio is we take the rents we get every month, we divide it into what the property costs us every month, things like principal, interest, taxes, insurance, and any HOA dues if they apply. And then based on that number, we get our debt service coverage ratio. So if our rents are $2,500 and our total payments are $1,839, then our debt service coverage ratio is 1.36. The higher the debt service coverage ratio, the better. And when you have over 1.25, your terms get better. Your interest rate gets better. If it's less than a 1.25, you can still get rates. The challenge is they're just not as good. Not as good, what does that mean? It means by 0.125 or 0.25. I don't want to paint the picture of it's, you go from 7% to 10%. It's not that drastic. It's 0.125, 0.25%. Let's look at this example again. Rents are $1,700. Our debt service is $1,470. Our debt service coverage ratio is 1.15. So again, your debt service coverage ratio, we take the rents that we receive every month and we divide into the debt of the property and we get a percentage. That percentage is our debt service coverage ratio. So if we're getting $1,700 in rents and then it's costing us $1,478, our debt service coverage ratio is 1.15. And obviously we want that number to be as high as possible, because the higher it is, well, obviously the more money that we make. Pretty simple. All right, mortgage and seasoning requirements on cash outs. Look, I talked about this. If you want to cash out on an investment property that you own based on the appraised value, you must own that property 6 or 12 months, depending on the loan type. Traditional conventional financing wants you to own it 12 months. Debt service coverage ratio financing wants you to own it 6 months. There are programs out there on the debt service coverage ratio that allow for 3 months. I haven't seen their rates compared to the 6 month, meaning I think you're better off just waiting an additional 3 months for better terms. But if you want the cash, you move forward, you do have the option. Now, that's if I want to cash out based on the appraised value. I have to wait either 6 or 12 months, again, based on the loan type. Now, there is a program out there called delayed financing. And what delayed financing allows you to do is to cash out within that 6 month period based on the purchase price or the appraised value, the lesser of the two. The caveat here is it has to be your money that either came from your checking account, your savings account, your retirement account, or your line of credit. The money had to originate back to you. And then you can get 100% of the purchase price or 70% of the appraised value, the lesser of the two. So if you bought a house for $200,000 and then it's worth $300,000, well, 100% of $200,000, the purchase price is $200,000. 70% of the appraised value, $300,000, is $210,000. The lesser of $200,000 and $210,000 is $200,000. Therefore, the max you can get back is what you paid for the property. So you couldn't capture additional equity within a 6 month period, but you can't get the money that you put back into it. So if you are someone that likes to buy properties cash, or you like to use your line of credit, or you like to use retirement funds that can be sourced back to you, then delayed financing is a great program for you to look into, because again, it allows you to skip the waiting times and just move forward with refinancing, get your money back, rinse and repeat the process without having to wait 6 or 12 months. All right, and then repeat. Look, we just want to do it again. As real estate investors, the biggest mistake I see us out there making is we stop prospecting. Like, look, you're in sales. And when you're in sales, you have to prospect, you have to prospect, you have to prospect. And the minute you stop prospecting is the minute your deal flow slows down. And so we like to say often what you're doing today is going to show up on your paycheck in 60 days and 90 days, depending on who you are and what sales organization you're in. As a real estate investor, I know exactly what you were doing 60 days ago and 90 days ago because I know your activity today. So if you're working on deals today, that's because the work you put in beforehand. And what happens is you get a deal, and I've done this time and time again. I get a deal, and I'm just focused on that deal, and I'm working on that deal. And what happens is that deal is over. When that deal ends, now I don't have another deal. So what I've trained myself to do over the years now is Paul, prospecting is not fun. I'd rather work on the deal. But the reality is whatever deal I'm working on, that deal is going to close. And when that deal closes, if I don't have another one coming down the pipe and another one and another one, well, then the well's going to dry up. And when the well dries up, well, it's just not fun. So you never, ever, ever stop prospecting. 80 to 85% of your time should be spent marketing. That's not me. Phil Grove says that. And I love, love, love that. Is 80 to 85% of your time should be spent marketing. Never, ever stop prospecting. All right, interest rates, where they are right now. We're a wholesale mortgage lender, meaning 9 times out of 10, our interest rates are always going to be lower than your banks, your credit unions, your online lender, or any other lender. And why is that? Well, wholesale is always cheaper than retail. We operate from a wholesale chain. Your bank, your credit union, they're retail. Retail is always more expensive than wholesale. When I say always, 9 times out of 10. There are the exceptions every now and then, but you should always check. Now, us, Blink Lending, look, we have tons and tons of different loan products, both for homeowners and for investors. So if you're looking to purchase a house to live in, we can do that loan. If you want to refinance the home that you live in for a lower interest rate, we can do that. If you want to refinance to get cash out, we can do that. If you want to talk about HELOC options, we can do that. We're not going to do the HELOC loan for you. We won't facilitate that. We're just not the best at it, but we do know others that offer great terms that we'd love to introduce you to. If you're an investor and you want to do a fix and flip loan, well, we can do that. If you want to do a BRRRR strategy loan, like we talked about today, we can do the short-term loan in-house, the private hard money loan. We can do that here. And then once you're done with the property, we can immediately convert the loan over into a long-term loan, all with the same loan officer, the same loan processor. You don't have to send your documents to multiple different companies and different lenders and spend time explaining your deal to multiple people. And so we can do it from the beginning and from the end, and then just go on to the next loan type. So any loan product that you're looking for single family houses, for duplexes, for triplexes, fourplexes, I like to say, please think Blink, as we love to present you some options. Our website is blinklending.com. As a real estate investor, you never want to go shopping without your pre-approval letter. House shopping, that is when a seller is going to take your offer seriously, what they're going to want to do is know that you're not only willing, but you're capable to buy the house. And a pre-approval letter is your way of showing them, hey, I've been pre-approved and I have the money to buy your property. Now, the pre-approval letter, you're often going to need it. It's going to be a Tuesday night, a Thursday night, a Friday night, a Saturday afternoon, or Sunday morning when I'm at church. And you're not going to be able to get in touch with your loan officer. Well, just because you can't get in touch with your loan officer for God knows what reason, it shouldn't stop you from getting your deal. So you can go to our website and you can get a pre-approval letter instantly. Anytime, any place, from any device, so long as you have internet. You answer a handful of questions. There's no documents needed. There's no credit report pull done. You just answer questions, and based on the answers that you give, it takes you 60, 90 seconds to complete it. You get a pre-approval letter instantly sent to your email. My advice to you is to make it property specific. So each time you're making an offer on a house, is put that specific address on the pre-approval letter. So when you're entering our software, put that address there, because now you're showing the seller 2 things. 1, I'm able to buy a house, and 2, I specifically got pre-approved to buy your house. When most people are shopping with pre-approval letters that say to be determined, you're going to say, I want to buy your house. So you can get it from our website, blinklending.com. Again, no documents necessary, no credit report necessary, no card inquiry. Answer questions, get your pre-approval letter, and sends to your email automatically. Here's my contact information. Should you ever have any questions, please feel free to reach out to me directly. That is my cell phone. That is my email. Every now and then I post some stuff on social media, real estate related. So if you're someone that's got IG, as the kids say, follow me. And I thank Real Estate IQ for having me yet again. You guys are amazing. I like to share often the story of how I met Steve Liang, the founder of Real Estate IQ. I'm walking into a Saturday morning networking event for the first Saturday of every month. For about 8 years of my career, I went to a real estate meetup called the Rich Club. Now, the Rich Club was an acronym. It stood for Realty Investment Club of Houston. And it was at 8 o'clock, the first Saturday of every month, and it went to 12 o'clock. So in my late 20s and early 30s, while a lot of my single guy friends were partying it up every Friday night, I was going home and studying my real estate books because the next day I had a bunch of clients to talk to. Well, one morning, as I'm reeling in my stuff, this other guy that looks completely lost is wheeling in his stuff. And he had this fancy TV and a PowerPoint presentation and everything. And I'm like, who is this guy? Well, long story short, it was Steve. Steve and I formed a friendship that day, and that was probably pretty close to 10 years ago now. So I'd love to see how far Real Estate IQ's come along. If you're not a member of their platform, do yourself a favor and just book a consultation to where you can walk through their systems, because you can choose to go get a realtor license and get access to only some of the MLS data that you're licensed in and pay for, or you can get with Real Estate IQ software, have access to not just Texas, multiple states, deals constantly flowing daily, the ability to run comps, double check your numbers. It just goes on and on. So I'm forever thankful to Real Estate IQ, Steve and team. I'm always rooting for you guys. And as always, thank you very much for having me. Until next time, if no one has any questions, I'm going to hop off and make my stomach stop growling. Yay, this works. All right, guys, listen, you were all awesome. Thank you very, very much. And it looks like Real Estate IQ is going to come back on.
Thank you. Thank you so much, Paul. Thank you for this amazing presentation. It's always a pleasure to have you with us. And thank you, everybody, for attending today. Hope you have a wonderful day, everybody. Enjoy. Bye.